Predatory lending is any lending practice that promotes unfair or abusive loan terms to the borrower. It is also any practice that persuades the borrower to receive unfair terms through deceptive, strong, arming, manipulative, or corrupt actions for a loan that a borrower doesn't need, want, nor afford. Predatory lenders tend to target individuals that need immediate cash for emergencies. They also target those who live below the poverty line, along with the elderly. Others who could fall prey to a predatory lender are usually people with low credit scores or people who have recently become unemployed. Predatory lending can take many forms such as payday loans, car title loans, tax refund anticipation loans, home loans, and so on. It is still unclear what constitutes predatory lending, however there are actions that are labeled as predatory lending practices. Inadequate or false disclosure is when the lender hides or falsifies the true costs, risks, and/or suitability of a loan's terms. It is also when the lender changes the loan terms after the initial offer. When these lenders come across someone with a low credit score, they will offer loans with very high interest rates. They will often carry far more fees and other hidden costs than reputable lenders. Loan packing is a practice where unnecessary products are added to the loan, such as a life or disability insurance to the loan, in order to charge more money. Loan flipping is a practice where the lender persuades the borrower to refinance an existing loan into a larger one with a higher interest rate and additional fees. Lenders will also persuade borrowers to refinance loan based on their amount of home equity. These loans are usually high amounts, and the lender pays no attention to the lender's ability to pay back the loan. This is known as asset-based lending. Reverse redlining is where a lender will operate in a neighborhood that is low income or has limited resources. These lenders will charge higher rates to everyone in the neighborhood regardless of their credit history or income. Balloon mortgages happen when a borrower is persuaded to refinance a mortgage with one that has lower payments in the beginning, but as time passes, the payments balloon into larger amounts. When the individual is unable to make the higher payments, the lender offers another refinance option with higher interest rates and fees. Negative amortization is set up in a way where the borrower's monthly loan payment is so small, it does not cover the interest. This will usually end up with the borrower owing considerably more than the original amount borrowed. Abnormal prepayment penalties are when the lender charges a fee for paying off most or all the loan earlier than scheduled. Lenders will charge these fees in order to recoup potential profits from long-term interest rates. Most lenders that charge these loans are online or no-bank lenders. Many prepayment fees on loans have time and financial restrictions as required by federal law. However, many subprime mortgages have higher than normal prepayment penalties. Mandatory arbitration is when the lender words the contract in such a way that will make it illegal for a borrower to take future legal action for fraud or misrepresentation. The borrower's only option left is arbitration. This will give the lender an advantage over the borrower. There are a number of people who predatory lenders tend to target. Subprime borrowers are people who generally have a credit score less than 630 and also have a low income. They are targeted by predatory lenders because they are able to charge a high interest rate. Low-income families are targeted and will end up paying more for loans regardless of the credit score. These families will fall victim to reverse redlining, which will push them into predatory loans. Elderly homeowners are popular targets for predatory mortgage lenders. Many elderly people live on fixed incomes, which makes it difficult to cover expenses such as auto or home repairs, medical costs, and so on. Predatory lenders use this to their advantage by persuading these individuals to tap into their home equity in order to receive some financial relief. Unfortunately, these loans will contain high interest rates and fees, along with other terms that will leave the homeowner at a disadvantage. Military service members are also targets for predatory lenders. Many individuals in service are young with very little credit history, which limits their options for loans. While older service members with families struggling to make ends meet dealing with repeated deployments and relocations make prime targets for predatory lenders. A report in 2006 by the Department of Defense found that lenders who offer products such as payday loans, car title loans, or unsecured installment loans tend to place their offices near military bases. People facing a financial crisis are targets of predatory lenders. These lenders will pose as saviors to individuals who are facing job loss, health issues resulting in high medical bills, or other unexpected expenses. These people are in a desperate situation and are easily persuaded into a loan that will put the borrower at a huge disadvantage. Damages caused by predatory lending impact many families and can last decades. The Center for Responsible Lending created a report that lists some of the largest problems with these loans. These loans have high default rates. Predatory loans have a high likelihood of default, repossession, or foreclosure. These loans are usually designed to place pressure on the borrower. These loans can cause the borrower to have their home foreclosed or have their car repossessed. Depending on state laws, the borrower could be sued or face other repercussions such as wage garnishment. The borrowers will have their credit score impacted. When these loans are defaulted, it can be damaging to the borrower's credit history. This could have far-reaching consequences as it can hinder the ability to get a future loan, rent an apartment or home, get insurance, or even get a job. The borrower could find themselves trapped in debt. After the borrower takes out a questionable loan, there is a good chance they could end up taking out another loan to make ends meet. This causes an endless cycle of debt. It can cause other problems for the borrower. Some payday loans offer direct deposit into a checking account, followed by automatic withdrawals for payment. This usually causes overdrafts in the checking account, which causes the borrower to deal with overdraft fees on top of the predatory debt. A predatory loan can cause the borrower to lose their home. This can bring an untold amount of financial and emotional stress on the borrower and their family. This could also make it more difficult to buy a home in the future, forcing the borrower to rent for a long period of time before being able to obtain a new mortgage for another home. Foreclosed homes could also affect the property value of neighboring homes. The U.S. government has taken steps to push back on predatory lenders. There are some laws in place that make it more difficult for predatory lenders to take advantage of unsuspecting borrowers. Truth in Lending Act, TILA, went into effect in 1968. Under this law, lenders are required to disclose the terms of a loan in writing to borrowers before they sign a contract. There are several other items that lenders must clearly present to the borrower. These items include the amount of the loan, the annual percentage rate, APR, any fees involved, the payment schedule, and the total of all payments. The law also gives customers who are refinancing the ability to cancel the loan within 3 days after signing it, also known as the right of rescission. The Credit Card Accountability, Responsibility and Disclosure Act of 2009, also known as the Credit Card Act, places limits on a number of practices that can be harmful to consumers. One example would be a requirement for credit card issuers to inform users about interest rate increases, prohibits them from applying new rates to old balances, and fees and penalties are required to be reasonable. The Equal Credit Opportunity Act, ECOA, was passed in 1989 and requires banks and other lenders to make credit available equally to everyone with the same credit rating. Lenders are unable to charge borrowers higher interest rates or fees based on race, color, religion, national origin, age, sex, marital status, or whether they receive any form of public assistance. The Homeownership and Equity Protection Act, HOPA, was passed as an amendment to the TILA in 1994. It bans abusive practices in high-interest home loans, such as equity stripping. Any loan that is considered high cost is subject to stricter disclosure rules than ordinary loans under the HOPA. The Military Lending Act, MLA, was passed in 2006 and reinforced in 2012. Under this law, lenders are prohibited charging service members more than 36% APR on any loan, including payday loans. It also prohibits loan flipping on loans to military personnel. It also makes it unlawful for lenders to implement loan flipping on loans to military personnel. Dodd-Frank. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 established the Consumer Finance Protection Bureau, CFPB, to police the finance industry. It provides information for consumers and a complaint form they can use to report predatory lenders. In addition to federal law, many states have created laws that help stop predatory lending. Here are a list of red flags of predatory lending. It seems too good to be true. Predatory lenders will make promises of quick cash, guaranteed approval, and very low interest rates, no matter the number of your credit score. But there is always a catch. The low interest rate could balloon after a few months. There could also be hidden fees. So keep in mind that if it sounds too good to be true, then it could be the case with the amazing loan you are being offered. Unlicensed loan offers. Look out for loan offers that you will receive through the mail, over the phone, or by door-to-door solicitations. Reputable lenders generally won't do business in this way. Check and make sure that your lender is licensed. One way to confirm if a lender is licensed is through the Nationwide Mortgage Licensing System and Registry, NMLS. You can also visit the Consumer Financial Protection Bureau's website for information and resources. Disregarding credit history. Predatory lenders will guarantee you approval for a loan regardless of your credit history or rating. This can easily be avoided by checking your credit report and find out what loans will qualify under your credit standing. Predatory lenders are not concerned with the borrower's ability to pay back the loan. They will find a way to get money from the borrower through means such as using a vehicle as collateral or having access to a checking account. All fees and costs are unclear. Reputable lenders always provide a disclosure that informs you of all the costs attached to a loan, which includes APR, term length, fees, and prepayment penalties. Predatory lenders will instead do whatever they can to hide these costs. If a lender seems to be hiding or unwilling to disclose information on a loan, you need to walk away. Being pressured or rushed to sign paperwork. Predatory lenders will move fast. They want you to sign paperwork without taking time for you to read and know exactly what you are getting yourself into. Make sure to review any paperwork and do not sign anything that you don't understand or may raise any concerns. You should walk away if the lender continues to rush or pressure you into signing. Electronic payments are required. Many lenders offer electronic payments directly from your account as an option. Predatory lenders, however, will require electronic payments as the only option. If you don't have enough money in your account to meet a payment, these lenders are likely to keep requesting the same payment over and over until they get it, leaving you with a hefty overdraft fee each time. High interest rates and fees. Take time to compare interest rates and fees to other loans on the market. Look out for any insurance policy or some other service that has been packed into the loan. Blank spaces. Do not sign any paperwork that contains blank spaces. Predatory lenders will fill in the spaces after you have signed the contract. Carefully review all documents and, if you are able, have the document reviewed by a professional such as a lawyer or an accountant. There are websites that warn of predatory lenders. One is the Federal Trade Commission's Scam Alerts page. Another website to visit is the Consumer Complaint Database, which is operated by Consumer Financial Protection Bureau. You can also visit the Better Business Bureau to look at customers' ratings. Keep in mind that reputable lenders will have some complaints. The shady lenders will have many complaints. Research lenders as you would any other product. Take quotes from multiple lenders. Take the time to find the best lender who can help with your financial situation. Some of these items will be camouflaged by a lot of wordy fine print, so do not be shy. If you come across a statement that seems odd or raises concern, make sure to ask. Anything but a direct answer should merit concern. There are some things that you can try if you are trapped in a predatory loan. The first thing you should do is report the predatory lender. File a complaint with the Consumer Financial Protection Bureau. You can report the predatory lender to the Federal Trade Commission for fraud if they deliberately lied to or misled you about a loan. You should report these lenders regardless of if you took the loan or turned it down. Putting these lenders on the radar can help stop their practices on other people.